the bond coupon rate is more, then the demand for my bond will increase. So if the interest rate will decrease, the price of the my demand will increase. So it will trade above the face value, because the new bonds which are getting issued, they are issued when the interest rate was low, so their coupon rate will be low. In my case, the coupon rate is already high. So in this situation, whenever you need to remember this thing, that the interest rate goes or decreases below the coupon rate, then the price of the bond increase and it goes above the face value, and vice versa. If in the economy the interest rate increases and it goes above the coupon rate, then the price of the bond goes below the face value. So let's suppose now the new bond after 1 year is getting issued at 7% coupon rate. Why people will come and get my 5%? So if they can get $35 after 6 months, why they are interested to get $25 of my bond after every 6 months, right? In that situation, the demand of my bond will decrease and the price will go down. And the main situation is over here that the people want to get compensated for the increased interest rate in the economy. And when the coupon rate of my bond is low, then the only way they can make up to 7% or higher interest rate if they will be able to buy my bond at a lower price. Simple. If you buy anything at a lower price and later on get more value by selling it, you will get higher interest, you will get higher return in that situation. Now look over here. This is how the fixed income securities are quoted, and you can see this thing 104.762. This is the last price at which the $100 face value bond is actually getting traded. Usually the face values are 1,000. So if this is the price for $100 face value, then what should be the price of 1,000 face value? Simply you need to multiply this 104.762 with the 10. So the $1,000 face value bond was last traded at $1,047.62. Once you multiply 104.762 with 10, you will get $1,047.62. What it is showing you about the interest rate in the economy? It is simply showing that in the economy, the interest rate has decreased and gone below the coupon rate. And this is the reason this bond is getting sold at a premium. So it has gone above the face value. So always remember the relationship of the price of the bond and the interest rate in the economy. It's basically it is inverse relationship. Once the interest rate goes up, the price of the bond goes down, and vice versa. If the interest rate goes down, then the price of the bond goes up. This is also the lesson from your introductory classes of financial management, when you have studied the bond evaluation, where you have studied the bond evaluation. So you can see likewise over here, what was the coupon rate? 5.75%. Because I can see it's selling at a premium, so for sure I know that the yield to maturity or the yield percentage, like if the new investor will buy this bond at this price and hold this bond until its maturity, then the annual return which is getting should be below the coupon rate. And this is what is happening over here. 5.121% is getting. Now in case of equities, you have two equities: common stocks and preferred stock. It simply means that you are the owner of the firm, and you have more rights obviously in case of the common stock, not that much in case of the preferred stock, but then there are risk involved as well. In case of liquidation, if the firm gets sold, the first right on the proceed on the liquidation proceed belongs to the lender of the firm, so who has lent the money to the firm. The second right goes to the preferred stockholder, and the last right goes to the common stockholder. But at the same time, the voting power is with the common stockholder. For the preferred stock, usually the dividends are in fixed value, and they are usually paid like periodically, and they have first right on the dividend compared to the common stock. That's why the name is preferred stock. They have been given preference when the dividend payment is made. If no dividend payment is made to the preferred stock, then no dividend can be made to the common stockholder. So first paying the dividend to the common stockholder, the company needs to pay dividend to the preferred stockholder. But at the same time, you need to remember that in case of preferred stockholder, dividend can be simply not paid. The management can decide that at this time we need we need to retain all the earnings within the firm to run the operation, and they simply deny paying the dividend to the preferred stockholder. So for common stockholder, what are the potential gain and losses? You can get the return in two ways. Number one, you can get the return through price appreciation when the price increases, but at the same time, if in the market the price goes down, you lose over there. Second, in case of dividends, but there is no set timing to pay the dividends, and there is no set dividend payment or amount of the dividend set for the shareholders. For example, in case of Walmart, last year they paid 2.12. Before that, they paid 2.08. Before that, they paid 2.04. So the dividend is growing, but there is no set payment of the dividend. So these are the potential gains and losses, but they have the voting rights. They can intervene and like in the annual general meetings and simply cast their vote over there on important matters related to the firms. In case, if you see the common stockholder, usually the prices are quoted like this. This is a very old chart of 2012, but you can see that this Apple stock, at that time, the price was $5.90 for each stock, and 3,033,000 shares almost was getting traded on the 1st May 2012. The change in the price was, it appreciated by $7.01, and the percentage change was 1.2 dollar. Now, if you want to see the Apple stock today, which is right now 17th of July, then in that case you can simply go in the and Google Yahoo Finance. Once you Google Yahoo Finance, it will take you to this screen, right? And over here, if you put the tickers, here you go, $385.31. This is the price of the Apple when the market closed on the July 17th. Information regarding the preferred stock is very hard to find. If you go one of the source for preferred stock, one of the platform or website from where you can get much information about the preferred stock is quantumonline.com. Otherwise, it's very hard actually to find the information about the preferred stock relative to the common stock. And mostly the common stocks are traded. Preferred stocks are seldom traded, and like usually, like if they are given or issued by the big companies. But mostly, it's actually common stock we are talking about. Over here, as I may have mentioned that the dividends are promised, but there is no legal requirement. So the board of directors, if they think that they need to retain the earning, they simply want simply say that we are not paying the preferred stock. But whenever we are not paying the preferred dividend, but whenever the dividend will be paid, first it will be paid to the preferred stockholder, and then it will be paid to the common stockholder. Sometimes the preferred stock are also cumulative in nature, in the sense that, let's suppose in 2020, a company decided not to pay any dividend, then and in any dividend both to the common stockholder and the preferred stockholder, and next year in 2021 they decided to pay the dividend for 2021 to the common stockholder. Then obviously they first have to pay to the preferred stockholder, but they also need to pay the deferred dividend of 2020, which they basically did not pay to the preferred stockholder. So first they have to pay all the previous dividends if have not been paid to the preferred stockholder, and then they can only start paying to the dividend to the common stockholder. So this is a cumulative nature of the dividend of preferred stock.